Hello property people, Steve again from GIP, and today is going to be a different kind of video. It's going to be a bit longer, so I do warn you. The reason why we're doing this kind of video today is because on the weekend I sent out an advert through Facebook, and anyone who works with us will know that we don't normally advertise the properties directly. We normally just advertise our consultancy services where we find you the right property for your specific needs and make sure it's a good investment. But somebody came across a desk last week which was a hotel room investment, and normally we don't really look at them unless we know the developer very well. But the developer was offering 10% guaranteed return for the next 10 years, and then in year 10 they'll buy it back off you for 125% of the original value. Now this seems too good to be true, so we had to look into it. So luckily I'm here in the UK for a couple of months, and I was able to go meet the developer, see the projects, and work out what was actually going on behind the scenes. And the reason why this kind of investment doesn't seem real is because we're not used to this kind of business model. Now, as investors, we're probably used to buying a hotel room in France, Spain, or Dubai, or something like that, where the developer will offer you 7% guarantee for the first 3 years, and then you're on your own. And if it makes 7%, great. If it makes 4%, then you only get 4%. But this is a different kind of investment, okay? This is a timescale investment. So on day one you're putting your money in at X amount, you're going to get X percent back over a 10-year period, and then your exit point is in 10 years' time at Y amount. All right? So it's not your normal type of property investment, but it's a lot safer. Now, the questions that you kind of throw at me is things like, is it too good to be true? Because a 10% return for 10 years just doesn't seem real. Now, it is real. All right? It is. I know it sounds too good to be true, but let me explain the business model to you, and then you will probably understand why and how they do it. So what the developer does is they look for under market value properties, and they look for, obviously, hotels. So I'm going to use some round numbers here, so please don't mess with me saying your numbers are too low or whatever. I'm using round numbers so we can understand them quite easy. So let's say the property value is £2 million. The developer will find a company who needs to sell that hotel for whatever reason. They'll be looking for a hotel that is maybe 10, 15 years old, needs a complete revamp, refit, needs some money spending on it. So the value of it is 2 million. They will try and buy it for 1 million. Okay, so they walk away with a property for £1 million. It's a hotel, it is running, so it is making money. What they then do is they then break the rooms down individually and they sell them to investors like yourselves. What that gives them is it gives them the return immediately. So let's say it's worth 2 million, they bought it for 1 million. They've already made 100% on their investment. But what they're doing then is they're trying to get their money back as fast as possible. So by selling the hotel rooms to investors, they draw them at their 1 million, so they can put that back in their bank account. So projects cost them nothing so far. They then take the remainder of the money from selling the hotel rooms and they put it into the revamp of the hotel. And they revamp this hotel over 2 years. So this is where the 10% guarantee comes from, and it's not just willy-nilly 10%. The secret is they never actually close the hotel. What they do is they refurbish this hotel room by room over a 2-year period. So they know that when they buy the hotel on day one, it's already making more than 10%. So let's say, for example, it's making 20%. They're already making 10% profit themselves, and they're able to give you your guaranteed 10% without any problems whatsoever. They then use your money that you invested in the property to revamp the hotel. So they're adding value to their own asset because they know in year 10 they're going to buy it back off you at 125% of the value. Now, in the UK, property values normally double every 7 to 10 years. It's been happening for many, many years. If you look back through the scales, then you'll see it yourselves. So by saying that they're going to buy it at 125%, they're probably going to be worth a lot more than that. So let's say you pay £100,000 for it. 10 years from now, it should be worth £200,000. And I've had people say to me, well, the developer's ripping me off. They give me £125,000 back, and it's worth £200,000. He's ripping me off. Well, no, he's not, because it's in your contract from day one. You know your start point, you know your 10% every year for 10 years is coming, and you know your exit point. So that's where you need to look at this. You need to get it in your head that this is a normal property investment, because it's not. Now, the reason why the developer does this is because they can borrow money from you as an investor a lot faster than they could borrow it from a bank. So by putting in the money out in the first place and then clawing it back fast, they can then take that £1 million that they took back out from your investment and buy another hotel. And this is how this company has gone from 0 hotels to 14 hotels in about 5 years. It's a really good way of doing it. It's a business model. It's a future business model. So you know these guys are in it for the long term, because they have to get to year 10 or year 15 before they actually make their big money. And the way that works is they either buy the hotel rooms back in year 10 off you and resell them for whatever the market price is there, because they've only given you 125% back, so hopefully it should be really worth 200%, and they take their extra on the top. Or they sell the hotel as a whole because they bought all the rooms back. Or, and the more likely option would be that they're in a position where they can then float the company on the stock market, and the guys who set it up will walk away very, very rich men. It's not something that is a common business model. Now, we've sold properties all over the world. I was in Dubai for many years myself, and I've sold lots of hotel rooms, and you're talking 7% guaranteed return, and then you're on your own, and it's you're hoping it's going to make money, and then in 10 years time you hope to sell it for a lot more than what you paid for it. But the key word there is hope, because nothing's guaranteed with it. Yes, you might keep it for 50 years, then sell it for obviously a lot more money, but with this kind of investment, it's a shorter term investment, and it's a guaranteed investment. Okay, so this is why and how the company can give you the promises that they do and make them real promises. Now, what you guys are asking are things like the safety of it. Is it a safe investment? Well, hopefully I've just answered that it is a safer investment than normal, because the developer is fully involved from the day they build it to the day they finish it. The hotel never stops running, so the income always turns over. And at the end of the 2-year revamp, they'll rebrand the hotel, relaunch it as a brand new hotel pretty much. All the prices go up, so they make more money in the term of the investment as well. So what happens if, and here's the risk thing for people, what happens if this developer goes bust? Because they've made you a promise. If they go bust, then the promise is gone, right? Well, there's 2 ways of looking at it. And the safety margin here is what you're actually buying, all right? What you're actually buying is a 125-year lease for that hotel room, which is only trumped by the sales contract in year 10 from the developer that you sign when you purchase the property. So it'll run for 10 years, and then in year 10, they take back full control of that lease. So they've still got 115 years left on that lease, which is worth a lot of money. So if they go bust, what happens? Well, you still own the property. You still own that lease. You still own the leasehold on it. So you're actually... Now, hear me out here, because people think I'm mad when I say this, but it does make sense in the end, I promise. If the company goes bust on you, or the developer goes bust on you, at no point in time are you going to lose the money that you've actually put into it, because you own the asset. It's your asset from day one. They just contracted to revamp the hotel around it, and obviously the room that you buy. But if they go bankrupt and the ideal situation if they were to go bankrupt would be in year 9. So if they went bankrupt in year 9, you would have got 10% every year. So on a £100,000 property, you would have got £10,000 back every single year for 9 years. So you've got £90,000 back. So you've nearly got your money back. Then the developer goes bust. You then have a 116-year lease to sell, which is worth a lot more than 125% of the property. But the reality of what happens is this. It's exactly the same as if you were to buy an apartment in a residential building, which is a managed building, and the company who's managing it could pop. What you do is everybody who has the title deed is given a vote, and you form what they call a residents association. And they're pretty similar things in the UK. They do them in the Middle East, they do them in Europe as well. So investors should be used to this kind of stuff. And you vote on a new management company, or you can vote on branding it if you wanted to. If you wanted to rebrand it, put it out to someone like the Hilton or Radisson or someone like that, then they would possibly look at it. It's a lot easier to do that than what people think. And I spent 17 years in hospitality and in hotels all over the world, and it's a lot easier to find a company who will do this. You've probably all seen it yourselves, where you've gone on holiday 1 year and you've stayed in a Hilton hotel, and you've gone back 5 or 6 years later and it's suddenly a Crane Plaza. The ownership hasn't changed, okay? The company hasn't changed. The hotel hasn't really changed, apart from the branding and the management company behind it. All they do is they change the management company. Management company normally lasts 15-year contracts, and that's how it works. So hotels don't go bust, people think they do, or close for no reason. The management company finishes, and then the owner puts in a different management company to give it a boost and a rebrand. That's the situation you would be in. You would still own that asset. The asset would still be yours. And let's face it, in 10 years' time, the asset is going to be worth double the value of what you paid for it if we go by what's happened in the past. Okay, so year 9 we've done the resident association. We've done why the developer does this. So what are the actual buying options for these properties? Well, the buying options are simple. You've obviously got your 3 options. You've got your mortgage, you've got your cash payment, and the developer give you what they call a defer option. So here's the thing with the mortgage, okay? If you're looking to take out a mortgage, this is quite a unique mortgage. High street banks don't normally do it, but there are guys who can get you these mortgages, and they're a good rate. Especially right now, they're a very good rate. And what we're looking at here is putting down 10% and then taking out a 10-year mortgage, which roughly on a £100,000 property would be a payment of about £775 per month. That sounds like a lot of money, maybe, for a hotel room, but remember, you're borrowing over a short period of time. And what it does is, as long as the repayment comes within the guarantee from the developer, you never actually pay anything out. Obviously, you're paying in the first place your 10% to get the mortgage in the first place, yes. But here's the thing, you have to remember, you also have to pay for year 1, all right? Because your investment return comes at the end of the year, so it comes in your 12th month. So you have to fund the mortgage for 12 months. So it's not just a 10%, it'll be £750 per month, which I think is £9,300, I think. My maths might be wrong, but anyway, it's roughly that. And then you're going to get a total return in your back pocket that year of £700 from the 10,000 that the developer gives you. Is it worth £700? Well, yes, because it's hands-off investment. Because once you get past year 1, you get your 10,000. That will then cover you for year 2. Year 2, you get 10,000. That'll cover you for year 3. That will go all the way up to year 10. Year 10, you own the asset outright. It's paid itself off when you've actually only paid out your initial 10%. They then will buy it back of you for 125% of the original value. So you're going to get £125,000 back, when in fact the only thing you've put down is £10,000 originally as your 10%. So the mortgage will pay it all off for you. It's a really good idea if you're in a mortgage situation like this, because you know that you can pay it every year because you're getting your guaranteed return. Okay. The defer option. Now the defer option is where the developer wants you to defer taking the payment out to getting your return for 2 years. And the way they do this is by saying to you, look, if you're going to buy a £100,000 property, instead of us giving you £10,000 year 1, £10,000 year 2, we'll take that off the actual original price of the property. So instead of giving us £100,000 today, you give us £80,000 today, and then we won't pay you for 2 years. Then in year 3, you'll start getting your 10%, which sounds attractive. But here's the thing: if you're taking out a mortgage, you can't do this. The reason why you can't do this is because, remember, you get paid at the end of every year, not the beginning or the middle. You get paid at the end of every single year. So at the end of the year, you're going to get your £10,000. But that'll be year 3. So you have to fund that mortgage for 3 years before you can take it. So what you should do as a mortgage buyer is take out the full mortgage of the full price of the property. As a cash buyer, is it a good idea? Well, it's only a good idea to defer it if you don't quite have enough money. So if you've got £80,000 in cash and you want to take a £100,000 hotel room, then it's a good idea, because obviously you're bridging the gap by not having anything back for 2 years. You're not borrowing the money because you've already got it. Are you losing money from your bank and the interest? Well, no, because you're gaining it you're going to gain it in year 10 when they give you 125% back of the price of the room, not the £80,000 you put in. They will give you £125,000 back. So hopefully that makes sense. As a cash buyer, my advice is that you put all your cash in. So if it's £100,000, you put your £100,000 in, and here's why. Because if you were to say, oh, well, I'm going to save £20,000 on the room, fantastic. You're not. Because you're going to take that £20,000, put it in your bank, and what are you going to get? A few £100 interest over 2 years. Whereas if you put it all into the project, you're going to gain 10,000 in those 2 years. And at the end, you get your 125% back of it anyway, so it doesn't really matter. So what you're offsetting is either your bank's interest rate or £20,000 pretty much over 2 years. So it's a better option to buy the thing outright and not take the defer. The only time I recommend you take the defer is if you only got 80,000 and you want £100,000 property. That is the only time. Okay, so we've done the mortgages, and guys, we are not mortgage providers. Okay, we do have preferred mortgage guys who we work with, and they're preferred because we've worked with them in the past and we know they're pretty good. But if you want us to put you in touch with them, then we can do that, certainly. So is it too good to be true? Well, as I've already answered it, no, it's not really too good to be true. It is a genuine investment, but you have to look at it as a short-term investment, and you have to look at it as a staggered investment. So what happens in year 10? Here's the key thing. In year 10, you have to sell it back. Well, no, actually you don't. Because people say, well, what if I don't want to sell it back? Well, you get the option to extend it to year 15. So you can turn it from a 10-year investment to a 15-year investment, and you get to keep the same terms. So if you're investing £100,000 into a room, in year 10, they will ask you if you want to extend it to year 15. You will still get that 10%. So you'll still get £10,000 every year for the next 5 years, which will give you another £50,000 in your pocket. And they will still honour the 125% buyback in year 15. Year 15 is the absolute cap. They won't extend it any more than that because it doesn't make financial sense to them. Also, I predict that in year 15 that these guys are going to be looking to float the company, as I said earlier. So they're going to need to have that asset back to them. So that's pretty much it. So your risks really are how much cash you've got and how much you can put in. The mortgage you can get. The mortgage has to be less than the actual return. Otherwise, you're going to be paying it every year. So you need to get a good rate on that. Currently, the rates are fantastic, and it comes under, and it shouldn't go up any more than the rate that you get back anyway. So it should always cover it. Should you put all your money in? Should you mortgage it? I know a lot of investors like to put money in, add value to it, then remortgage. Well, here's the thing: don't mortgage at the start if you can afford not to. Take your 2 years, because you're going to get £10,000 back each year on the property. So you're going to make £20,000. Okay, instead of saving the 10,000, the 20,000 from the price, you're going to get your 20,000 back. Then, if you want to remortgage and release the equity, release it in year 3. Because if you take out the mortgage from day 1, then you're not going to get your money back. Whereas if you take it out in year 3, you've had your 2 payments of £20,000. Fantastic, that's in your back pocket. You then mortgage it, and then you're mortgaging only 7 years worth, 8 years worth of a mortgage. Or you can spread it over the 10 years, and it's going to be a lower rate altogether. So they're your options. They're a developer who are forward thinking, obviously. They're a developer who doesn't borrow money, so their risk is lower than normal. We are looking ourselves at buying one of these properties, and we're going to buy it on a mortgage. And the reason why we're going to buy it on a mortgage is because we want to put as little in as possible, and we want to get as much out of it as possible. So we're going to be looking at exactly £100,000 apartment. We're going to be putting £10,000 in. We're going to be funding that mortgage for the first year at £775 per month, and then at the end of year 1, we're going to get that £10,000, which is going to cover the mortgage for year 2, and so on and so on and so on. At the end of the term of the 10 years, we will extend. We will take the 15-year term contract, and we will get another £50,000 and then sell it at 125% of the actual value. We will buy this not as an individual, so Steve will not buy the property, my company will buy the property. And here's the reason why. If I was to buy the property, I have to sell it back to the developer if I forfeit the term. So if I want to get rid of the property, I can sell it back to the developer any point from year 5 to year 10, and I will make a profit because they will guarantee it. From year 5, they'll give you 105% of your original value, so I would make £5,000 back. Obviously, it staggers upwards to the 125% guarantee. But if I have a limited company who owns the property, and then I sell a limited company, the property now actually changes legal ownership. It's always owned by the limited company. I can sell that to anybody. It doesn't have to be the developer. I can sell it to anybody I like. So I might get more money for it in that way. It also protects me in the fact that it will be worth more to my company than it will be to me personally, because I want to sell the company. It comes as a forward-running asset, which is always good. So they're the options that we're using. If anyone has any more questions because I forgot to cover anything or something springs to mind, please get in touch and we'll have a chat and we'll discuss your options, which are best for you individually, because everybody's different. And you have to have a plan. Luckily, these kind of investments come with a plan, because you know day one you're paying X amount, you're going to get your 10-year guarantee, and then you're going to sell it at Y in year 10 or 15. So that's it, guys. They are a good investment. You can visit them. The bonus for this one is you get to stay 2 weeks per year in the hotels. But you can stay in any of the hotels. It doesn't have to be the hotel that you buy the property in. So they own 14 hotels at the moment. That will go up, obviously. And you can pick and choose any one of their hotels that you stay in. But you can only stay in a room that is the same level as yours. So if you were to buy a mid-range room, you can't stay in a high-end, the highest-end hotel room. If you buy a high-end room at the 180,000, you can stay in any hotel room you like in the entire portfolio of the developer. So that's a nice little perk. Again, any questions, please get in touch and maybe we can answer and even arrange a viewing if people want to see them. So thanks very much, thanks for listening. It's been a bit longer than normal, I know, and I do apologise, but hopefully you've got a bit of a better idea of how these investments work and that they are real investments. So thanks, bye bye.